Hello there, everyone, and welcome to the latest episode of our Market Misbehavior podcast. My name is Dave Keller. I'm the founder of Market Misbehavior and the president and chief strategist at Sierra Alpha Research. I'm so glad you're joining me here on today's show. Our goal with the Market Misbehavior podcast is to have more laid-back, relaxed conversations with top market practitioners, money managers, strategists, analysts, traders, authors, educators, anyone that has an interesting perspective, whose insights and expertise add value to our own attempts to understand the market environment. And today we have a really good guest, Megan Horneman. Megan's the Chief Investment Officer at Verdence Capital Advisors based in the Baltimore area. A perfect time to chat with Megan because we've had an incredibly volatile 2025. After the low volatility bull market of 2024, 2025 has brought extra volatility, extra uncertainty, rapidly changing, scripts with tariff news and a lot of headline risk. Perfect opportunity to talk to someone with a great long-term perspective, with a great sense of how market corrections and recessionary periods have ended up resolving in constructive ways in market history. I really enjoyed getting Megan's take on the markets here in May of 2025. We talked about a lot of different macro themes and concepts. Megan boiled it down to three main areas of focus: earnings, economics, and inflation. And we sort of teased out each of those in a good amount of detail in our conversation today. In terms of earnings, we're sort of wrapping up Q1 earnings. So I thought her take on, what quarterly earnings really represent, why the forward guidance is much more important, and the uncertainty surrounding that guidance, given the rapidly changing tariff landscape and challenges for companies actually determining how much of an impact that could be in the months and quarters to come. On the economic side, we talked about recessionary fears. We talked about the Fed with their meeting this week and an outlook for Fed policy changes through the course of 2025. We talked about the challenges of the Fed really, not wanting to commit to a cut cycle until absolutely necessary, and some of the indicators she's watching closely in recent weeks. Finally, we talked about inflation in particular and focused in on some of the different ways we can tease out inflation. We talked about last week's ISM number. And again, what's great about talking to someone like Megan is something like the ISM number is something some of you may not be super familiar with or really understand. And she was able to, I think, describe how we measure inflation, some of the different indicators that she's tracking, and what that might mean for equities and other risk assets. We also talked about US versus non-US markets. We talked about opportunities given recessionary fears and the long-term opportunities that they often represent. We talked about the importance of consumer data and why that is arguably the most important thing to follow here. Just a lot of great words of wisdom and investing insights on how to manage through and diversify through a period of market uncertainty and market instability. Really great conversation with a knowledgeable investor, and I'm really thankful for this one. So please enjoy this conversation with Megan Horneman, the Chief Investment Officer of Verdence Capital Advisors in Baltimore. So I'm super excited to be sitting down today with Megan Horneman. Megan's the Chief Investment Officer at Verdence Capital Advisors in Baltimore. Megan, I followed your work and I've watched you in financial media. I'm so thankful you're coming on the show today and sharing some thoughts with our audience. So welcome.
Thank you. Thank you for having me.
So I feel like we've had whipsaw of sorts with an aggressive sell-off into an early April low, an equally aggressive V bottom rallying off of that April low. Now we're sort of in a big question mark zone as to whether this move that we've seen is sustainable. When you kind of take a step back and take a deep breath and reflect on the data you're able to gather, where's your head at in terms of the sustainability of the gains that we've had off of that early April low?
So if we take a step back and go back, right before that April 2nd Liberation Day, which started the sell-off in the equity market, The equity markets were pricing in pretty much almost a perfect situation happening for this year from an economic standpoint, from an earnings standpoint, from a Federal Reserve standpoint, from an interest rate standpoint. And what we were very cautious coming into the first quarter of this year, because we saw there were a lot more risks than the market had been pricing in. And one of them was that Trump was coming in, guns a-blazing, ready to go with his policies that he campaigned on. And we saw with immigration immediately, and we knew that tariffs were next. We did not anticipate what we would see, the aggressive tariff action that he took. But what we think that sell-off that you saw in the market was just what we call a repricing, an adjustment to a new expectation for all of these things that I mentioned. So companies and investors had to reprice the risks for earnings. That was a big thing. They had to reprice the risks from an economic standpoint, and then reprice inflation risks. And typically when you see such a violent kind of repricing of expectations, you can see big whipsaws in the market. It started with the equity side. We got between 10 and 20% decline, depending on which index you're looking at. And we also saw a lot of volatility within the fixed income during that time as well. And when you see such violent moves like that, market and investors are typically very good at overstating or overshooting to the upside and also overshooting to the downside. So we view that as a bit of overshooting, because at the end of the day, you had to take an opinion on what you thought would end up happening from the trade perspective. And what we've always thought is that, President Trump comes in way far out with a deal, and then we're for it to meet somewhere in the middle. And we anticipated that there would be some good news on the trade front, and any good news at that point, because he had laid out such a worst case scenario, any good news would be good news for the market. And so that's how we've seen this big rebound. I think there is some of this pricing out of the worst case scenario from trade. Now, as we go into the summer, and I do think we'll get quite a few of these trade deals that'll be ironed out. We think this is more of a first half of 25 story, because the second half of 25 is going to be all saved for the Tax Cuts and Jobs Act. He's got to have the time and focus for that. But now we have to deal with the secondary impact of the tariff, and even just that tariff announcement, even though the tariffs aren't fully in effect yet. What does that mean for the economy? And the economic data always lags. So we're starting to see that. So we don't think the volatility is completely behind us. We think we may have seen the near-term low here in the market, but we do think you could see some more volatility as we start to see this kind of work its way into the economy.
It's so funny. I feel like as a technical analyst, I've made a career off of watching the markets overreact on the upside and the downside. That's sort of that. Yes. So that definitely resonates with me, and I'm sure my audience as well. So you talked about a number of things, right? You talked about earnings, you talked about economics, you talked about inflation, and sort of those three main buckets, which I think is a great way to think of it. We're wrapping up earnings season this week, or sort of the Q1 earnings season. When you look at what we've learned from companies, I mean, general trend that I've seen is beating quarterly estimates. That's overall been pretty constructive, but forward-looking guidance less rosy, with some exceptions, or just flat out removed. Right, as we're unclear. What do you think are the big takeaways from earnings season this quarter? What is that? How does that set us up going forward in terms of valuations, do you think?
Well, first of all, just as you mentioned, this is first quarter earnings season, so it's backward looking. The results are good; they're beating expectations. Companies typically do, but it's the guidance and the pulling of guidance that has the markets create. There's been quite a bit of volatility in here. What the second takeaway we're really getting out of this is that earnings for the full calendar year are being revised lower. And we've been waiting for this. The earnings expectations, even up until Liberation Day, were way too high. Even without a tariff announcement, the earnings were too high. We were seeing the economy starting to slow. So I think the second takeaway of that is we are seeing the full year earnings getting a little bit more realistic. There's probably still a little bit more room to go. And the last thing is that companies really don't know how to factor the tariffs in, because just like everyone else, they don't know what the end result will be. They don't know if this is a one-time thing or if it's going to turn into a broader trade war. And I think the final thing we're taking away from this is there is a lot of concern around consumer behavior. Consumers have shown sign of softening. And remember, the economy in the US, it's made 70% of that roughly is made up of consumer spending. So if the consumer starts to slow, that impacts earnings and it impacts the economy. So those are some of the takeaways that we get out of this earnings season.
Oh, that's really, really well said, Megan. I appreciate it. Talk a little bit about valuations, because
Mhm.
hard to argue that valuations were incredibly high going into a February peak. Now that we've rotated lower in April and bounced higher, you could make the argument valuations are still pretty high relative to where expectations are at. How does that
Mhm.
play into your outlook looking forward? Do you think valuations are still above where they would need to be? Are they about right? Are we at a Goldilocks level yet? How do you think about that side of it?
I think there are certain segments. Let's look at the US equity market first. There are
Hmm.
certain pockets of the US equity market that I think valuations are fair valued, if not relatively cheap. So if you look at small and mid cap stocks, now you have to have a long term investment horizon because they are economically sensitive. When you look at the US large cap space, they've gotten cheaper. Yes, I
Mm,
mean, don't get me wrong, you had almost a 20% decline in certain areas of the market. So the PEs did come down quite a bit. Now, I think when you look at US large cap growth and technology, this magnificent seven, these areas of the market that really led the market so high and overvalued coming into the first quarter,
yeah.
these areas aren't necessarily cheap to us yet. They're not a screaming buying opportunity. If you're looking at the large cap space, we still would stick with maybe value over growth right
Hmm.
now. But the real, areas that look attractive within the US are that small and mid cap space. And
Yeah.
then don't forget internationally, especially developed international equities, they have rallied quite a bit in the past 6 or 9 months. But keep in mind, when you look at them compared to the US, they've still lagged the US significantly for a longer period of time. So there's
Yeah.
room there to catch up. So there, if you don't have allocation international, it's never a bad time to look at that. They have, like I said, valuations have gotten a little bit more expensive than they were 6 months ago, but still relatively cheap compared to the US.
No, I'm glad you went to some non-US markets, because year to date, certainly from a technical perspective, a lot of these charts look a lot more constructed than we've seen in the US, making new highs
Yep.
in Germany and developed Europe, developed Asia. That's really, really helpful. How can you talk a little bit? For those that are struggling with the extreme volatility that we've experienced in 2025, I feel like 2024 was sort of this low volatility. You can get away with a lot because it was just sort of a relatively painless uptrend. Now things hurt, right? There's big moves on both ways. How have you learned over your career to navigate periods of higher volatility and keep a proper long-term perspective? Any tips or tricks for investors that are struggling right about now?
Yeah, I think the biggest thing is diversification.
Hmm.
So it's very easy to get caught in momentum driven trades. For example, the Magnificent Seven for 2003, 2004, the AI craze. It's very easy to get caught up in those types of trades,
Yeah.
but pay the appropriate price for what you're buying. And those multiples were so expensive, it didn't warrant purchasing those areas. So you have to be very careful, and that's the areas of the market that have been hit really hard. You
Yeah.
have to be very careful of following momentum, and you have to be focused and disciplined on A, your long-term objectives, and B, diversification. Don't be afraid of bonds. Don't be afraid of commodities. These are the areas of the market that will offer you that diversification. And don't be afraid of other areas of US equities. Don't be 100% in US large cap growth. You would have had very difficult returns and had a lot more volatility in your portfolio than someone who was well diversified in large cap, mid cap, small cap, international
Yeah.
equities, and then having some bonds and alternatives in your portfolio too. That's really where you can mitigate that volatility. It's painful to see, and it's tough for investors to absorb the headlines and what you see just from the US equity market. But if you have a well diversified portfolio, you're not just in US equities, you're in a lot of different asset classes that should diversify you and smooth out those returns over the long run.
No, that's really well said, Megan. One thing you didn't mention specifically, but you did mention sort of alternative assets. What about gold and precious metals? This is an area of the market that's arguably shown a lot of strength despite a lot of volatility in the equity space. When you're looking at an allocation, how do you think about commodities, particularly gold, silver, other precious metals, among other bets you could be making at any point?
It's really tough to buy anything at a record high, in our opinion. And even though gold keeps making new record highs,
Yeah,
gold is still, even though it is a store of value, it still has some speculative characteristics to it.
yeah,
So people are buying it because they're concerned about the trade war, they're concerned about the dollar, they're concerned about, global debt. There's many things that they're concerned about. The reason why we're not jumping into gold right here at these record highs is because it's one headline away from seeing a lot of downside. So if there
yeah.
is trade deals made, if if the president eases up on this, or if more people come to the table, it is a flight to safety investment as well. So you're going to see people pull out of that, and you'll see equities rally. So just be careful buying something that's been driven so much on momentum and speculation. I think commodities as a whole, remember the commodity space, there's so many different areas in there as well. You have
Sure.
oil, you have agriculture, you have a lot of different things. If you can have a well-diversified commodity exposure, so you'll always have some gold in that because gold's a huge portion of the commodity market. If you have a well-diversified portfolio exposure to commodities as a whole, I think that that's good for the long run.
Mm.
Real assets, commodities, these alternatives, they always have a spot in a portfolio for the long run.
Yeah, no, that's a great way of describing that. I appreciate it. Getting back to some of the economic data, I mean, inflation, I feel like is just always in the back of our minds. And I was watching on your YouTube channel, Markets with Megan. You're talking about the ISM last week, and sort of the inflation component. What are some of the economic data points that you think are most important to watch in the weeks and months going forward to really understand inflation and what sort of impact that could have on risk assets?
Yeah, so inflation's the big risk here, and you'll hear the Fed talk about this tomorrow because regardless of what happens from a tariff perspective, tariffs are inflationary, and
Yeah.
we do have some new tariffs that are on and even on right now. So how is that going to filter into the underlying inflation data that we get? First of all, it's not going to happen overnight. It will take some time. The one thing that we do think is it's not going to result in some sort of a double-digit inflation or even COVID-like inflation because companies are sitting on record high profits as well as very high margins. So there is some room for companies to absorb some of this, and there's less ability for. I think there's less appetite for consumers to pay up for it, and that's something that companies have always adapted to when it comes to a pricing perspective. Some of the things that we're looking at, where do we spend the majority of our money? It's typically on the service sector. So
Mm.
yesterday, we got the ISM Services Index, and that is the kind of sister index to the manufacturing index. And we saw that prices paid in both of those indices are high. And this is insinuating that there is inflation pressures in the system. Now, does that mean it's going to translate into our consumer price index or our PCE? That's going to take a little time before we see that. But it's hard to say that we won't see some impact. We think it'll be a one-time type of inflationary impact, but it's difficult. The inflation is still difficult for consumers to absorb because they've been dealing with inflation really for the past 5 years.
Yeah.
So you're piling on another risk of inflation on top of 5 years of prices that just keep going up and up and up. While the pace may be slower, they still keep going up and up and up. So we think that this is probably going to keep the Fed on the sideline, at least in May. June, that meeting's up in the air. It's going to depend on the economic data, but there's a lot of inflation data to watch. Always watch those prices paid components in the ISM surveys. Watch the wages in the payroll reports that we got last week that were relatively tame. Look at owner's equivalent rent in the CPI. We'll get CPI, PPI, PCE. We'll get all these in the next week or so. So there's a lot of indicators from inflation that the Fed can have under their belt before they go into their June meeting.
So we got the Fed meeting coming up this week, obviously, and on Wednesday we sort of get the latest update. Market not pricing in any policy change this time around, but obviously a lot of people will be looking at the dot plot and expectations for future cuts. What are your expectations? What do you think we will be hearing, and how do you think of that as part of, or how do you work that into your outlook for equities in the months to come?
So we don't think the Fed's going to have as much flexibility as some people are pricing in.
Yeah.
And, we're kind of seeing that after the payroll report we got last week. The expectations for this month for a cut this week were cut down to basically zero. There still is about a 30% chance they'll cut in June. We think that they will be able to cut, but they're going to be very careful because they don't want to stop and go monetary policy. So they don't want to, I think they would rather stay on hold than cut interest rates and then have to raise them a couple months later. So
Right.
That's why I think they're going to be more cautious. They've been very vocal on the fact that they can't make monetary policy decisions around a trade policy that they don't know. So at least they understand at this point what that worst case scenario may be. You may see maybe in some question and answers or in their bigger minutes, there may be some comments about if these tariffs do get implemented the way that they were, what that might be. But I do think in the dot plots, you'll see probably some pricing out of future rate cuts. There still will be some, but not to the magnitude that was priced in. And I think that the Federal Reserve Chairman will speak a lot about the labor market and speak about the risk for inflation. I also think that what they need to, and what they probably will, and we've heard it a bit, is they'll say whichever one of our mandates. So whether it's the labor market or inflation, or if it's inflation, whichever one of those mandates is further away from our target, that's the one we'll focus on. So the labor market is not deteriorating substantially yet. There's been cracks, absolutely. Well, there should be, because we have a slowing economy and the labor market's been so tight, but we're not seeing a collapse in the labor market. Now, but the inflation side, all we're seeing is upside risks to that. So I think you'll hear more about inflation from the Fed and the fact that they're watching that and they're watching that closely. And that may, lead to some further pricing out in the futures market of rate cuts for this year.
Yeah, you mentioned the slowing economy, Megan, and we had the negative GDP, for the first time in a couple years. A lot of people now, all of a sudden, the dreaded word recession has come up. We're starting to think about that. What would you tell investors that are concerned about a recession and what that could mean to the equity markets in 2025? How does that influence your thinking today?
Well, typically recessions end up being a fantastic buying opportunity, and markets tend to bottom out before the economy does. So, what I tell investors about recessions is recessions are normal and healthy. They're a part of every economic cycle, and they're important because if you don't have a recession, you don't clear out excesses. I think that the economy has been much more resilient than we even anticipated, given the fact that consumers' balance sheets are weak. You have consumer credit card debt at a record high, delinquencies high. People are basically paying for this inflation on debt. And we knew that eventually this would come to a head, that this would not be able to continue. So it's healthy for consumers to take a step back and pause. We drove inflation higher after the pandemic from the just excessive government spending, as well as consumers just buying, this euphoria-driven reopening of the economy and buying everything they possibly could. So we have we're at fault as well for driving this vicious inflation circle that we have. We need to clear that up. We need to get back to a healthier inflation level, and we need to stabilize it. So we got inflation lower. We got out of that really high inflation after the pandemic. But if we don't get that under control, then we'll just be in you'll end up in a 1970s, 80s type of situation, which was not good for equity. So I remind investors that recessions are absolutely part of every, not only economic cycle, but investing cycle. They typically happen every 4 to 5 years. And if you go back in history, they typically are always a good buying opportunity from stocks. So we're looking at any weakness where valuations start to get attractive this year as buying opportunities. If you have cash on the sidelines, it's good times to put it to work. We're not going to have these cash levels forever because the Fed will cut rates, and you'll get a better entry point into equities. So you have to be disciplined and withstand some of that volatility, the short-term volatility. We came into this year, fortunately, with a good deal of extra cash in our models. So we had dry powder to put to work, and we have been doing it. We're not doing it today. We did it when the markets were down 10 to 20%. and we'll look for more opportunities for cash, whether it's in the equity market or fixed income. But don't be afraid of the pullbacks. These pullbacks are part of investing. And with every 20% correction or bear market that we get in it, you typically see double-digit returns a year later. So it's not something to be substantially afraid of. It's tough to stomach. Don't look at your statement every day, and don't look at CNBC or Fox Business every day. Just know that it's part of all its cycles, and it tends to be a good buying opportunity. The one thing I also would say in this environment where volatility is starting to accelerate, make sure that you don't get completely focused on index investing. That means passive investing. You want to make sure you have some active mutual funds, active ETFs, active separately managed accounts. These managers are looking at, they got boots on the grounds. They're talking to these companies. They know who's going to be the most impacted from different economic situations or different trade situations. These are the ones that are going to be able to have the flexibility to make changes throughout the volatility. If you're in an index investment, you're going to come down as much as the market does. And you may participate in what the market does on the way up. But I think from the active side, they're able to really look at the balance sheets of the individual companies. That's really where you want to focus when it comes to investing in these periods of volatility.
Megan, that was like 2 minutes of fantastic investment wisdom right there. But a couple of things that you mentioned, fantastic, right? If your runway's long enough, major corrections have always been fantastic buying opportunities, right? An opportunity to buy great companies at a discount. It's like having a 20% off coupon for some really good companies. So I like that. And some of my former Fidelity colleagues used to say, if you're a passive investor, you have 0% chance of outperforming. You literally have you have no chance of doing better than average. So why not take a shot at it? Megan, this was such a pleasure. I really appreciate your perspective and really a nice level-headed approach to all of the noise and volatility that we've experienced here in 2025. Where can we point people to learn more about you and your work and what you're doing at Verdence Capital Advisors?
Yeah, thank you so much. So we do a lot from publications. Follow us on social media. Our marketing team puts all of our weekly information on social media. Our information is also on our website at verdence.com. You can go to the podcast that I do on a regular basis. This is usually a few times a week where we hone in on some of that economic data that you and I discussed. What it means for the economy, what does it mean for the asset classes. We also do impact reports when there is big spikes in volatility or you have big days where the markets has substantial moves, where we'll update on our current thinking, what's going on, what are we doing. All of these can be followed on marketswithmegan.fm as well.
It's fantastic. Megan, thanks again. Pleasure to meet you. Great to have you on the show. I hope we can continue the conversation down the road.
Absolutely. It was wonderful. Thank you for having me.
I tell you what a perfect conversation to have right about now. If you feel like you've been getting whiplash from all the sudden changes, from optimism to pessimism to optimism to headline risk moving things all over the place to the corrections and recessions and the fears of what could come next. I thought Megan's take on things was just really welcome right about now. Just thinking about diversifying through this period, thinking about asset allocation and where opportunities can be. Really making sense of valuations and how companies are trying to adjust their expectations and how the market is trying to revalue companies based on those forward-looking projections, and just how to navigate through a corrective period. Again, what I've learned having gone through a series of market pullbacks and corrective periods, from 2000 to 2025, and hopefully for many years to come. I think Megan's comments at the end were spot on, right? The market has recovered from 100% of every market correction. So if your runway is long enough, big sell-offs in stocks often and almost always present us with great long-term buying opportunities. So, just thinking about how we find those opportunities, thinking about why diversification can matter and help us getting through an uncertain period. The opportunities of looking outside of mega cap growth to other areas of the market, which Megan certainly spoke to. I thought all of that were really valuable insights, and I really appreciate her specific ideas around valuations, around potential tariff impacts, following the actions and sentiment around consumers, around inflation data, and just how to make sense of Fed policy and economic data here in the weeks and months to come. Great take there from Megan Horneman, Chief Investment Officer at Verdence Capital Advisors, and thanks again to Megan for joining us on the show today. If you like what we talked about today, and particularly you need help navigating these markets from a technical perspective, what we do at Market Misbehavior and at Sierra Alpha Research is give you the tools and techniques, a practical set of tools with which you can analyze how the markets are anticipating economic shifts and expectations, and what the price action actually tells us about euphoria and desperation, fear and greed, all those emotional drivers as prices overshoot and undershoot where they should be, as Megan put it in our interview today. If you need help improving your own toolkit in that area, our Market Misbehavior Premium memberships may be a great solution. 3 great benefits to the Market Misbehavior Premium membership. First off, access to all our virtual courses. We'll teach you about technical analysis, particular technical indicators. We'll teach you about behavioral biases and what happens between our ears, why it's so difficult for us to make good decisions in our portfolio, and the tools and techniques we need to use to improve our market awareness. Second benefit, all of our members-only reports like our weekly flight plan, which we put out every weekend, and our monthly chart review, where we apply our proprietary market trend model to a series of asset classes and ETFs. Finally, you'll have access to our members-only community where you can ask questions, where you can get support from myself and a bunch of other like-minded investors as we navigate these uncharted waters together. Great way to get help, to get support, and to have a group of investors navigating things together. For more information on our premium memberships, including pricing, etc., go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. I'm Dave Keller, reminding you it's always a good time to own good charts.